if my employer offers both the CARES loan and the CARES withdrawal, compare and contrast both of those for me, and which should I consider taking first or prioritize?
So there's a couple of really important things to think about in comparing the CARES loan and the CARES withdrawal. First, let's talk about taxes. Now, if you're going to repay, whether it's the loan or the withdrawal, your tax impact is going to be the same. You're not going to pay taxes on either of those options. But if you're concerned about your ability to repay in the future, the CARES withdrawal may be more favorable to you, as you definitely will not face that 10% early withdrawal penalty. On the flip side, if you take that CARES loan and default on it, the full amount of the loan will be taxable to you in the year of the default, unlike the CARES withdrawal, where you have some flexibility to spread those taxes over multiple years. Another really important consideration is repayment. If you really want to repay this amount to the plan and limit your impact on your retirement outcomes, while you can make repayments under either option, the loan may be a better choice there. It's going to have a set repayment schedule where repayments will occur regularly, either directly from payroll or directly from your bank account. That makes it way easier to repay that money. Under the CARES withdrawal, well, you can make repayments. It's not a fixed process, and you'll be responsible for setting up those payments and sending them to your retirement plan administrator or other retirement account. And we all know how difficult it can be to remember to make those payments on a regular basis. And then another important consideration is just broad retirement impact. Couple things to keep in mind there. The CARES loan, those repayments do include interest. So while you're paying yourself back with interest, that's going to get you closer to the retirement balance you would have had if you had never taken a withdrawal. With the CARES withdrawal, again, while you can repay that amount, if you don't make that repayment, or if depending on the timing of that repayment, you could be missing out on significant earnings, and that would, of course, reduce your overall accumulated retirement balance. You know, we recognize nobody wants to tap into their retirement savings early, but in times like these of financial stress, may be an important resource in order to be able to meet your everyday living expenses. And you do have flexibility under either option to make repayments and ultimately restore and improve retirement outcomes relative to not repaying those balances at all.
And so it's important to talk with your advisor if you have one, or to contact your plan's record keeper to see what tools and resources they have to help you make those decisions, correct?
Yeah, absolutely. Contact your retirement plan administrator. They can confirm for you the exact features that are available in your plan and the process to take a withdrawal. They can also help you understand the detailed impacts on your account and direct you to even more tools and resources to really help you understand exactly how these actions might impact your retirement readiness.